to you by Emerald Financial Group. Emerald exists to help investors make informed decisions about their investments. We offer a range of services to help educate, support, and motivate everyday people to get involved in the stock market. We offer services for any experience level. Now today, I'm joined by my colleague Sam Green. We're going to go through what our view is for the second half of the year. We kind of gather it's a good time to catch up and the financial year. We haven't been able to do one of these videos for a while based on Victoria lockdown. So now we're getting back into the rhythm of regularly updating you guys on what our thoughts are of the market. So welcome, Sam. Sam, I guess we will start is COVID.
Absolutely. And thanks very much for having me. Good to be back. And so COVID back in Australia in not a big way, but a noticeable way. Noticeable because of more so the associated lockdowns, I'd say, in New South Wales, Queensland now, snap lockdowns in other states as well. And you're starting to see that be reflected on the market.
Yeah.
So a lot of the more domestically focused stocks, things like that, they are facing a bit of selling pressure, have done for the past fortnight or so. But some of the online retailers, some of the stars from the initial Victorian lockdown are starting to outperform. It'll be interesting to see whether this is just a short-term thing or whether this takes a while to play out.
Yeah, I think I've in the past lockdowns that we've seen in Victoria here, the market hasn't really cared too much because I guess the cases have stayed under control fairly reasonably, right? The recent lockdown we saw maybe at most 11 cases in one day. So we know snap lockdowns can work, right? But I'm a little bit fearful with New South Wales being at 20 plus. They may have a bit of an extended lockdown here. So let's just see, right? I don't think it's going to have a huge bearish sell-off or anything like that on the market. But I think we could definitely see certain stocks hold back a bit here until the end of the lockdowns. And, and I think that's probably the common theme that we'll see over the next couple of months.
Yeah, I'd definitely agree with that. It's a evolving situation. It will depend on how New South Wales in particular plays out, and we're all hoping that it wraps up rather quickly and that vaccination rates increase and we can get to reopening.
Yeah, now I guess that's the next big point, right? Is the vaccination. So for me, long term, for our market to continue to perform similar to the US and follow the US higher, we want to see some light at the end of the tunnel with vaccines and the rollout. If we don't have a good rollout of vaccines in the second half of this year, I believe we will continue to disconnect next year from world markets. In particular, because as an economy, traveling and accepting immigration back in and all that sort of stuff is really tied to vaccination. So we may get left behind here, guys, if we can't get this vaccination rollout done properly.
Yeah, absolutely. I think we were a little bit slower in, at least as a nation, in pushing vaccination and in getting everyone vaccinated because we didn't have that sort of initial big bout of COVID, and I think the governments of Australia are regretting not pushing it a bit harder a month or so ago, and scrambling to try and rapidly advance it now. But I think we're about 3.5% fully vaccinated, and a bit over 20% have had at least one dose. So we are starting to get some runs on the board. Hopefully it speeds up a bit from here.
That's it. And that's one of the things I'll be watching for over the next 6 months anyway, is a long-term gauge on whether we're going to continue following world markets higher or disconnect a little bit. So I guess the big one, right? The big one everyone's talking about is central banks, inflation, bond tapering, interest rates rising. All right, that's probably the big one that everyone's focused on right now. What's your take on that, Sam?
Well, I mean, it depends who you listen to because the Fed itself is a bit fractured at the moment. We've obviously got the Fed Chair, Jerome Powell, continuing to speak as dovishly as he possibly can get away with, trying to soothe markets with his words. But you've got other Fed members, Bullard and Kaplan and the like, who are a lot more hawkish and who are coming out and saying, we're going to have to taper sooner rather than later and perhaps sooner than people think. And if they do taper the bond buying, as I believe the market now expects them to do in the near term, we will see I think, pretty profound effects on some parts of the market. Already, I think we're seeing that start to flow into the government bond market. We've seen flattening yield curve movements in Australian and US government bond yield curves. And that's starting to weigh on the banks a bit. So I do think the tapering discussion is going to continue. I think it's something we're going to see play out a lot more. In terms of actual interest rate rises, I still think they're a long, long way off, if ever they happen.
Yeah, and that's the thing, they're talking about, end of 2023 for the Fed at the moment, and that's still a long way away, and the view can change dramatically between now and then, right? So
exactly.
they're talking about increasing interest rates, not going, okay, well, interest rates need to go up now. So we're a long way off this, aren't we, right?
Yeah, I believe so. And I think, people are saying, well, runaway inflation, they're going to have to lift interest rates to combat that inflation. And I don't necessarily think that it's a black and white statement like that. I don't necessarily think that we are going to see a sustained bout of increasing inflation. There's, if you look at the numbers, there are fairly strong reasons why at the start of this year and perhaps for the next few months, we will have strong levels of inflation. And they're mostly due to what I would say is, or what the Fed would say is, more transitory effects. There was a big drop in prices, during the virus period, and we're rising off a low base. There's, an issue with logistics and transports of some goods, and that's pushing prices up. There are supply chain issues in certain goods, and particularly things like computer chips, and that's pushing prices up. But these things aren't sustained runaway prices. They tend to be, at least in my opinion, more short-term focused things that can be rectified as time goes on, as opposed to being driven by an overheating economy.
Yeah. I think we've all got to keep in mind as well, if you go have a look at the Fed website and look at their mandate, it says they want to maintain a 2% average inflation over the long term. So we've had a deflationary period through COVID. Even prior to COVID, we had a bit of a deflationary period, or low inflation period, I should say. So I guess if we have even half a year at 3% plus, it kind of balances things out a little bit too. So as long as it is transitory, I don't think interest rates are going to go up. If anything, it might be 0.25%, just so there's a bit more ammunition in the barrel again. But
I think you're right. I think we're going to have to adjust, and the world will have to adjust for a lower interest rate world. The years of overnight cash rates of 3%, 4%, 5%, I think are long gone.
Yeah,
there's been too much credit created at low rates that the economy can't sustain the amount of credit at higher interest rates.
Yeah.
It's I guess an unfortunate situation, or maybe it's a fortunate situation, but the average US taxpayer has about $200,000 of US government debt to their name. The US government can pay that off if interest rates are at 0%, but if they're significantly higher, it's just infeasible for the current economic situation.
And then on to the RBA as well. They're talking about having a quarterly catch up on bond tapering. So they're going to be flexible on bond tapering. They can increase, decrease bond buying depending on how the economy outlook is looking like at any point of time. Last I heard is they're still targeting 2 to 3% inflation. They're happy to keep inflation up near the 3% target for a period of time. What they really want to do is get the unemployment rate down to about 4% and try and start driving that wage growth, right? And that's what we want to hear. I think as an economy, if we hear that, that means we're going to get ourselves out of a hole. The big thing for me, long term, to have inflation stay above 2% is wage growth. If we don't have wage growth, my belief is we're going to go back to pre-COVID. We'll have inflation way below 2.
Absolutely. So, yeah, I think the RBA is being a lot more honest in their statements, and they say they're targeting positive economic outcomes. They say they have, an employment target, and that's why they're, doing the monetary policy that they're doing. I think if I could fault the Fed, they've not talked enough about why and the stimulatory effects they're trying to achieve. Instead, that they're focusing too much on the inflation and interest rate discussion. So I would say I think the RBA is doing a great job, and I think our own bond buying tapering, it won't come for some time.
Yeah. So look, what's the reality? Short term at the moment, I've never seen central banks this accommodative before. This is extremes. And we don't see that going anywhere anytime soon. Okay, so I think we're pretty safe for at least the next 6 to 12 months on that basis. That the debt markets are going to have really cheap money that supports the equity markets. So if anyone, and there's a lot of doomsday is starting to come out of the woodwork now because markets are getting pretty high. I don't think it's time, guys. I actually don't think it's time for the markets to pull back at all. I think there's still plenty more upside, especially for the US market with their successful vaccine rollouts and more infrastructure spending coming from Biden.
Yeah, absolutely.
So, I'm still on the bull side, especially in the US. And if the US markets go up, we tend to follow. Right? So that's the vast reality. So infrastructure spending should lead to some strong commodity prices. Absolutely.
So already we've seen commodity prices hit, mostly all-time highs for a lot of commodities this year. We see that sort of grinding higher again. Part of at least the story of metals prices at the moment is there was a big drop in CapEx spending amongst miners, exploration and mine development spending from about 2014 to 2017-18, and that is translating to the higher prices now. I think there's a bit of a lack of supply at the moment, and we should see that rectified in the coming years. But just for the time being, metals prices and other commodity prices are extremely strong. And we think, it will take a while for that to be rectified. It takes time for, especially a metals mine, to be set up.
And, therefore, our miners are extremely cheap at the moment. Our big three in particular, Fortescue, Rio, BHP, are very well positioned to take advantage of this high commodity price environment. And, extremely cheap PEs. So keep an eye on those.
Absolutely. I think approaching the August reports, we'll see a lot more interest flow into those miners. Markets come and go in waves. There's certain sectors that are doing well at times, certain sectors that are doing well at other times. And we think that there's been a lack of interest in the miners. They've traded too cheap relative to what their earnings will be. And that should flow back into them in the coming months.
Look, and there's been a lot of fear around China, right? So I can see where the hesitancy has been in people buying anything that exports to China. But the reality is going to kick in August reporting, isn't it? So, probably a couple of pretty high or special dividends coming investors' way. I think they're going to stay strong for a good year or so from here.
Yeah, absolutely.
Anything else that you're seeing around the marketplaces at the moment?
Well, we talked about the flattening of the government bond yield curves. That does weigh on, I guess, the domestic residential mortgage focused banks. That style of banking is pretty explicitly borrowing at the very, very shortest of terms and lending at the very longest of terms. So ideally, with that sort of banking, you want a nice steep yield curve where you have very, very low short-term yields on government bonds and very high long-term yields. In the past couple of weeks, we've seen that yield curve flatten out a bit. And I think that's created a bit of selling pressure on some of our major banks, the big four.
What I'd be personally watching out for there is whether it's going to flatten further. Because if you have a look at the yield curve itself, it's still fairly steep compared to where we were 12 months ago or so. But if it keeps happening, if it keeps flattening, that's where the banks are in big trouble. I can't see much more upside in the short term in the banks.
No, I think that some of them are priced pretty much to perfection. Westpac, ANZ, NAB, you could argue there's a bit more value to be had there, but CBA is probably at sort of historic valuations for it. And when it gets to these levels, it tends to soften off a bit. It'll be hard, I think, for the other banks to rise too much without CBA also rising.
Yeah, definitely. Okay, so the other thing I'll quickly lay mention on is given quite a strong outlook that we've got on the US markets at the moment, we're also now including US recommendations inside our Emerald Equities product. So, or also a service in which you can trade US equities at a very competitive rate as well. So if that's something you're interested in, jump across our Emerald Equities website and have a look, okay? Or feel free to give one of us a call and we'll have a chat. One of the stocks I'm looking at the moment actually is Facebook. Forward PE of under 30 has got potential yearly earnings growth above 20%, and looking on a nice big roaring uptrend. Okay, so I'll bring that up because a lot of these people are out there at the moment saying that US market's getting overheated. And yes, I agree, some stocks in the US market are extremely overheated, Tesla for one, but there's still a lot of good, cheap growth and value stocks over there.
Yep, absolutely. So I think a lot of people read the articles, they see the numbers, and it can be a trap to fall into to say, well, this is overpriced, so the market's overpriced, or
That's right.
the average stock is overpriced, so everything's overpriced. There are a lot of attractive opportunities, and one thing we're really excited for is being able to provide US recommendations and information, because it's such a much broader market. There are so many attractive opportunities there, regardless of what their market is doing.
Yeah, and I really agree with that point that a handful of expensive stocks doesn't mean a market's overheated. There's plenty of great stocks in our market and in the US market that are still running at very attractive PEs. If you don't know enough about that type of fundamental analysis, guys, it's something you're going to get educated on. Okay, so once again, we've got a beginner's course that we run for free online. You can jump in there. We'll give you some of the basics around the market. So you'll find that once again on our Emerald Financial website.
Absolutely. We've also just gone out with our first US stock recommendation.
Correct.
If you'd be interested in hearing about that, I suggest you head over to emeraldequities.com.au.
Yeah, fantastic. Okay, so I think we'll wrap things up there. Thanks for listening in, guys.
Thanks very much, guys.
Don't forget to like our video and subscribe. Take care and bye for now.